Central banks may seem distant and complicated, but their decisions shape your daily life more than you realize. How can a single institution influence prices, jobs, loans, and even the value of your money? In this video, we'll clearly explain how central banks control the economy using simple tools like interest rates, money supply, and policy decisions. No confusing economics language required. You'll see how these choices affect inflation, growth, and financial stability, and why central bank announcements can shake markets overnight. Today, we will talk about how central banks control the economy. So before we start, make sure to hit the like button and subscribe to my channel. 1. Role of central banks. Central banks are powerful institutions that sit at the heart of every modern economy. Their primary role is to maintain economic stability by controlling inflation, supporting employment, and ensuring a stable financial system. Unlike commercial banks, central banks do not serve everyday customers. Instead, they act as regulators and guardians of the entire banking system. Examples include the Federal Reserve, the European Central Bank, and the Bank of England. Central banks issue national currency, supervise banks, and act as lenders of last resort during financial crises. Their decisions influence how much money flows through the economy and how confident people feel about the future. When economies grow too fast or slow down sharply, central banks step in to guide conditions back toward balance. Because their actions affect interest rates, borrowing, saving, and investment, central banks quietly shape everyday financial life. Understanding their role helps explain why economic policies change and how financial stability is maintained over time. 2. Interest rates as a control tool. Interest rates are the most visible and widely used tools central banks employ to control the economy. By raising or lowering interest rates, central banks influence how expensive it is to borrow money. When inflation is high, central banks raise interest rates to slow spending and reduce price pressures. Higher rates discourage borrowing and encourage saving. When economic growth slows or unemployment rises, central banks lower interest rates to stimulate spending and investment. Lower rates make loans cheaper for households and businesses, encouraging expansion and consumption. This balancing act helps stabilize economic cycles. Even small rate changes can have large effects on housing markets, business investment, and consumer behavior. Interest rates act like a brake or accelerator, allowing central banks to fine-tune economic momentum without direct government control. 3. Controlling money supply. Central banks also control the economy by managing the money supply. This refers to the amount of money circulating within an economy. Too much money can lead to inflation, while too little can slow growth. Central banks influence money supply through tools such as open market operations, where they buy or sell government bonds. Buying bonds injects money into the economy, while selling bonds removes money from circulation. Another tool is reserve requirements, which determine how much money banks must keep on hand instead of lending out. By adjusting these mechanisms, central banks control liquidity in the financial system. Managing money supply helps stabilize prices and maintain confidence in the currency. This behind-the-scenes process plays a crucial role in keeping economies functioning smoothly. 4. Inflation targeting. Inflation targeting is a key strategy used by many central banks. This means setting a specific inflation goal, often around 2%, and adjusting policies to achieve it. Stable inflation helps consumers and businesses plan for the future with confidence. If inflation rises above the target, central banks tighten monetary policy. If inflation falls too low, they loosen it. Inflation targeting improves transparency and credibility, helping anchor public expectations. When people trust that inflation will remain under control, they are less likely to demand excessive wage increases or raise prices preemptively. This trust reduces economic volatility. Inflation targeting shows how central banks use clear goals to guide decision-making and maintain long-term stability. 5. Banking system regulations. Central banks regulate and supervise commercial banks to ensure financial stability. They set rules that banks must follow to prevent excessive risk-taking. This includes capital requirements, stress testing, and oversight of lending practices. A stable banking system is essential for a healthy economy because banks provide credit to households and businesses. During financial crises, central banks step in to prevent bank failures from spreading. Acting as lenders of last resort, they provide emergency funds to stabilize markets. This role helps prevent panic and protects depositors. Effective regulation reduces the risk of economic collapse and maintains trust in the financial system. 6. Responding to economic crises. During economic crises, central banks play a critical stabilizing role. When markets panic or financial institutions fail, central banks intervene to restore confidence. This may involve cutting interest rates rapidly, injecting liquidity, or launching emergency lending programs. In severe cases, central banks may use unconventional tools like quantitative easing, which involves large-scale asset purchases. These actions help keep credit flowing and prevent economic collapse. Crisis response highlights the flexibility and importance of central banks in managing extreme conditions. Their ability to act quickly can determine how deep and long a crisis becomes. 7. Influence on employment. Although central banks do not directly create jobs, their policies strongly influence employment levels. Lower interest rates encourage businesses to expand and hire more workers. Higher rates slow hiring and investment. Many central banks include employment as part of their mandate alongside price stability. Balancing inflation control with job growth is challenging because these goals can sometimes conflict. Central banks must carefully evaluate economic data to avoid triggering unemployment while controlling prices. Their influence on labor markets shows how monetary policy affects real lives beyond financial markets. 8. Communication and expectations. Central banks control the economy not only through actions but also through communication. Public statements, policy guidance, and economic forecasts shape expectation. When central banks clearly explain their goals and plans, markets respond more smoothly. Clear communication reduces uncertainty and prevents sudden market reactions. This approach, known as forward guidance, helps businesses and consumers plan ahead. Managing expectations is as important as managing interest rates. When people trust central banks, their policies become more effective. Communication has become a powerful modern tool in economic control. 9. Limits of central bank power. Despite their influence, central banks cannot control everything. They cannot fix structural problems like inequality, low productivity, or political instability. Their tools mainly affect financial conditions, not long-term economic fundamentals. Over-reliance on central banks can also create risks, such as asset bubbles or excessive debt. This is why coordination with government fiscal policy is important. Recognizing the limits of central bank power helps create realistic expectations and balanced economic strategies. 10. Why central banks matter to you. Central bank decisions affect your daily life in many ways. They influence loan rates, savings returns, job opportunities, and inflation. Understanding how central banks control the economy helps you make smarter financial choices. Whether you are borrowing, saving, investing, or planning for the future, central bank policies shape the environment around you. While their actions may seem distant, their impact is personal. Knowledge empowers you to navigate economic changes with confidence and clarity. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.